Central banks dumping. What do they know? Hi, everyone, and welcome to another episode of Insights brought to you by Ainslie Bullion and the Gold and Silver Standard. Today, we welcome back Sam, who's been looking at the FOMC meeting this morning, the interest rates, all the implications and outcomes of that. How are you going today, Sam?
Good, Chris. How are you doing?
Yeah, very well, thank you. It looks as though interest rates are on hold as expected. We have been talking about that in the past, and that's pretty much what we thought was going to happen. There was some major market movement, though. So what did the FOMC do to rock the markets?
They've hammered on with higher for longer, which is what they've been saying. And they've also talked about the 25 basis point hike that they're leaving as an option for later. Mm-hmm. Now, do we know they're definitely going to do that or not? We know they change their mind all the time. They've done, rate cuts and hikes way earlier than they said they have in the past. So this could just be some scare tactic. But one of the things they did actually get into detail on was it noted that tighter credit conditions will weigh on households and businesses, as well as hiring and inflation. Now, they did say the effects are uncertain, the degree of how bad it will be, but it did make a really clear bad tone with listeners and with investors that they're expecting bad things to happen, and it's not going to stop them from staying higher for longer. And it looks like the markets didn't like that. The S&P immediately started to dive, and gold had a dip as well, just from that temporary strength in the US dollar, which we know if they start to print again will disappear pretty quickly.
Well, they have been in such a tough situation because and you made that point just then, they have to sort of say higher for longer because that's, they can't just say, oh no, we're going back into a cutting cycle, but they've got to try and balance it. It's a bit tricky, that balancing act that they have to try and pull off. But do you think the Fed really is uncertain about the effect of tighter credit conditions? Because you would think that they pretty much know, right?
Well, what's their job? Their entire job is easing and tightening credit conditions. Yep. That's it, isn't it? That's their stated goal, to try to calm the economy by tightening and loosening credit. So if you look at the past, the very, very recent past, you'd probably remember the huge scandal the Fed had where they bought and sold during the pandemic crash at the perfect time. So the market bottomed out, they bought in. These are Fed officials buying in. And then shortly after that, announcing quantitative easing like we've never seen before. And once the markets had skyrocketed at the very tippy top of the market, they said, look, we understand how you feel. We should exit the stock market now. We shouldn't be playing around in the stock market. And they cashed out at the very, very top for ethics reasons. So
yeah, there were ethics reasons at play, that's for sure.
So it seems they know a lot more than they're letting on now. Also, if you look at what central banks have been doing in the last quarter, now you look at the S&P 500, it's been going up. People have been jumping in, whether it's small retail investors or big investors, you can't really know, but there's been money piling into the S&P 500, and there's been a big AI narrative. But if you look at the major central banks, what the Fed, what the ECB, Bank of Japan, what these major banks have been doing, they've been unloading their assets. They've been unloading their securities. Now, their assets typically correlate extremely tightly with the S&P 500. Yep. So if they're accumulating, S&P 500 is going up. Now, S&P 500 has been going up in the recent quarter, while they've been doing the opposite and unloading. So what, which is the dog and which is the tail? Are retail investors going to start, wagging the Fed around and saying, no, you have to come back in and start buying up all these assets? Or does the Fed know something we don't know and they're unloading to anticipate the market dropping?
I certainly know which way I'd be placing my bets there. And it's that, when we've seen that same thing happen previously, you probably think that maybe that's at least some elements of that at play again. So are there any other charts or pieces of information that you look at or that we could look at in terms of seeing what the Fed is doing? Because obviously we can't really listen to what they're saying, because you've given that perfect example where, you've got to really watch what they're doing, not so much listen to what they're saying.
Yeah, well, you can just look at the money supply. I mean, you look at the M2 money supply, and it was big news when it started to go backwards, when it started to go down, because if you look at money creation, it's this really steady arc that's been going upward, very, increasingly aggressive slope upward. And then it started to turn around and go down, albeit after huge unprecedented money printing. But it was big news when it started to reverse, and now it's not news at all. No one's talking about what the M2 money supply is doing. And if you look at it, it had a little bit of a shake, but it hasn't really broken out of its negative trend line. It's been descending, and markets don't care. They're going up. Fed central banks are unloading, money supply is decreasing, and it's still going up. And that's where you have to really find out, do people know what the money supply is? Do people really know what it means? Because to give an extreme example, there could be the best new AI project in the world. There could be the greatest new inventions in the world. But if we had $0, let's just say there was ultimate credit tightening and we had $0, no one could spend anything.
Yep.
If there were unlimited dollars, people could buy anything. So what people have to do is come up with a degree of somewhere in between and say, what's happening with the money supply and how's that affecting markets? And it looks, by what the central banks are doing, they don't have any questions about how that works. They know they're offloading.
And that does make sense. I mean, I tend to look at that a little bit differently, looking at it from a global perspective, but certainly what we see in the US, that lines up.
So I did see your chart about the global liquidity cycles. And we talked before about how, the Fed said they're tightening, and everyone's talking about inflation's being tackled from the tightening, but actually all the money created in China, if you balance it out, it was actually a surplus of money moving around. And we know countries aren't, countries do business with each other, money gets around. So I wanted to ask you about your liquidity cycles, about global liquidity and how that might play into this.
Yeah, well, and I did put that video, which was linked in the news today, out, which really just looks at how I look at it personally. I'll try my favorite new toy on Zoom of sharing my screen here. So we'll see if this works. Hopefully it does. Okay, so this chart here probably shows a little bit from my perspective of the difference, because I absolutely agree with what you showed in the news today about the US with that M2 money supply tightening, or falling back. But what this shows generally, you can see this sine wave over top. This is work from Cross Border Capital and Michael Howell. And what he's been effectively pointing out is that we have this over a long period of time pattern where we sort of go through mini cycles within the bigger cycle of generally more money being printed, where there's tightening, which is what we've been through, and then we go through global expansion of monetary supply. And the argument is that in about October of last year, we saw those lows actually in the global cycle. So differentiating again between the global and the M2, the global liquidity cycle generally, and that we are now starting to pick up. And it's exactly what you just described, with that driver being heavily China and other probably emerging economies that have been faster to the pivot back into trying to stimulate their economies, particularly in China after COVID. As we know, they opened up a lot later, and that created some issues. I'll just show one more chart that I think is really useful on that I didn't focus as heavily on in the video, but is really relevant for us, I think. And that's to look at, so this red and green line here is the global liquidity cycle over the last 5 years, and looking at the gold price. So this is the average gold price for the month, and there is quite a strong correlation there. So what we had is the gold was effectively bottoming out in late 2018-19 when the liquidity cycle was bottoming globally, and peaked almost exactly at the peaks in the liquidity cycle that we experienced in late 2020. So there was that high correlation. Then it started pulling back. We had this little tick up here that happened because of the start of the Ukraine war, but after that, while this tightening was going on, gold did suffer as a result. But what I find most fascinating is just like it was back earlier in the cycle, again, when liquidity seems to have bottomed in October last year, we've got this beautiful bottoming in the price of gold as well. So it's very interesting to look at that global picture to see, as liquidity, clearly we're at the bottom, and this does align with what you were saying around what we've been seeing in the US as well. But we're still skidding along the bottom here. But as that picks up, at some point again, we will see these green highs, and gold starting from this higher base is looking pretty good, in a pretty good situation to take full advantage of that. So that's
gold traders are they're calling the bluff.
Well, exactly. And if you looked at it from that angle with those markets, the gold traders are saying, well, you could be absolutely right that we do experience even a substantial pullback in the shorter term, but they're probably looking beyond that to say, well, we know one way or another, the spigots get turned on and the money comes flooding back in. So they probably are calling that bluff and attempting to look through the market.
And the S&P 500, do you think that will be as resilient as
No.
gold across the next few months?
No, I don't. And my perspective on that is the S&P 500 has probably dislocated a bit from that liquidity cycle and has gotten ahead of itself, whereas gold really hasn't. And you see that. We certainly notice there's not that sort of froth in the market. People aren't talking about the latest AI trend impacting gold, for example. Gold has been kind of out of favor, which works in its favor for being priced pretty correctly, even against a backdrop of everything else falling.
Well, if they keep pushing it and they crash the markets again, they're going to have to find a way to buy in personally a little bit more secretively this time than they did last time.
Well, yes, because that ethics argument still has to make you giggle, right?
Yeah.
Oh dear. Well, Sam, thank you for all that today. A great look at where we are in the market and what we can potentially see on the horizon. So no doubt you'll be keeping an eye on that, and we'll catch up and discuss that more next week.
Thanks, Chris. See you next week.
Thanks everyone for watching. Remember, reach out with any questions or comments on the social platforms. That's us for this week. We'll be back on Tuesday with Alex to discuss all things markets and metals. Until then, have a great rest of the week and weekend, everyone.